Okay, again, good evening, everybody. This is Hamad Sarwar, your tutor for the Prepare to Pass session, Practice to Pass session of paper F7. Uh, in the last session of day one, I have given you two questions. The one is triaged and the second one is sent down. I have received number of answers from the student side, and I'm very happy to see that mostly the students are good in terms of working. But as far as the presentation is concerned, I'm very much angry with the students that mostly the students are not performing well as far as the presentation is concerned. And there are a number of silly mistakes I have identified that most of the students are doing. So I have selected some scripts. So whatever answer you have emailed me, I will email you back with the personal feedback on individual basis. But I have selected few scripts for the discussion purpose. Like one of the email I have received from one of the student, you can see, I think, on your screen. Yes, you can see here that the question starts with the statement of financial position. At the year end. So it's better for you to write the complete name of the statement of financial position, as that. So these are basic things that will give you some marks. Then in this question, you can see here that there is a clear missing of precision level. There is no precision level mentioned here, that my whether the values are in dollars or in pounds or in euro. So whatever be the currency unit, and the precision level is clearly missing. So if we are doing the question in dollars, so it's compulsory for all of you to show dollars with some precision level, or it might be a euro, or it might be a pound. So these are actually the requirements of IS 1. So these are the basic silly mistakes that we made in the examination. Now, property, plant and equipment with some values I'm not discussing right now. Just I'm not discussing right now the concepts. Right now I'm just focusing on the presentation. So if you can just simply bold the non-current assets and current assets, so it will be better for the examiner to understand, and your the data will be more presentable. Similarly, equities and liabilities should be highlighted properly. Then liability section, it's better for you to do some, for the sake of the good presentation, you just highlight your key answers. Like uh, this student has highlighted only the total assets and total liabilities and capital, but it's better if you highlight all the key areas. So starting from the statement of profit and loss, uh, it shows the revenue of 3,76,000. Again, the currency unit is missing. Again, the precision level is missing. So please prepare yourself according to the examination point of view, rather than you are just doing the rough work. So there is no time to do the rough work. It's a complete time to do the practice with full presentation. Otherwise, it will be a problem for you in the examination. Now, then if you highlight the gross profits better and presentable, if you highlight the gross profit, then profit before tax and tax expense and profit for the year. Again, now the second one I wanted to mention is the second thing I want to mention is there are some serious mistakes. Mostly the students who got failed in the examination on 48 or on 49 marks, mostly they are on average basis they are passing the examination, but examiner intentionally uh, failed these students because of the fact that students have done some basic fundamental mistake. Like you can see here that there's a value of property, plant and equipment here is 80,000, and this student has incorporated the value of the brand in the property, plant and equipment. This is basically the fundamental mistake. If you do this type of mistake, the examiner will definitely uh, fail you. So there's a high chances that you will be flunked in the examination if you are adding intangible asset into tangible asset. So the property, plant and equipment heading is only for the assets of IS 16. That is for tangible assets. And IS 38 covers all the intangible assets. So the brand should be reported separately. So this is actually the fundamental mistake. So for the sake of the presentation, again, I'm highlighting the key things so that your answer will be more presentable for the examiner. So these are the basic points I wanted to discuss in this script. One more script. Again, this student again has done the same type of mistake by adding, sorry, by adding the brand. You can see here the adding the brand in the property, plant and equipment section. So this is again wrong. Examiner can give you 0 marks in the complete question if you do this type of mistakes. Statement of financial position, there is no name of the company. The name of the company is mandatory according to IS 1. So you should have to mention the name of the company, then the name of the statement and its period. So if it is a balance sheet, it should be as at or as on, and if it is an income statement, it should be for the period ended. Again, the precision level is missing. Again, the currency unit is missing. Now, one more thing I wanted to show here, the basic mistake which one of the student has done. You can see here that when this student has calculated the gross profit, he or she does just simply add these two values, which is totally right. But in calculating the profit before tax, the calculation should be from the gross profit. So this student has just simply add these figures in the calculation of the gross profit rather than the calculation. It should start from the gross profit. So from the gross profit, when we deduct all the expenses, we got the value of the profit before tax. So this is again a silly mistake, and you can see here that before this working, the answer says you that there is a loss before tax, and when I have corrected this mistake, there is a profit uh, that is reported in the income statement. So this is again a very big mistake which the student can do in the examination. So these are the silly mistakes from which you have to learn. Similarly, there is a loss for the year rather than there is no loss. It is actually a profit for the year. So if you do this type of mistakes in the practical world, there might be a serious heart attack to the shareholders. Again, one of the biggest issue is the impairment loss of the brand. This student has charged the impairment loss of a brand in OCI. We have discussed clearly in the last session that the gain on the disposal, the gain on the revaluation will only be reported, can only be reported in the OCI, and the losses will be charged in the income statement. So this 4,500 should be reported in the income statement rather than OCI. Again, this is again a type of the fundamental mistake which the student has done, and the examiner can give you 49 marks. Even if you are scoring other than this mistake, if you are scoring 80 or 70 marks, examiner will give you just 49 marks. So examiner intentionally sometimes fail the students who do the basic level fundamental mistakes in the examination. So so our let's start from the first slide for today. Okay, there's a question from the student. I send mine, it bounces back. I just resend my assigned even through I shared with the WhatsApp group. Okay, sustain account. Okay, there is an other mistake which I have identified that some students are doing some sort of mistakes even in the uh, when they are writing. So, for example, if we if I write loan and loan, there is a serious and significant difference between these two loans. So these types of mistakes I have also identified in some of the scripts of the students. So this is nothing to do with the financial reporting actually, but it is all it's totally dependent on your English. So if you write loan in the balance sheet with this spelling, the examiner cannot do anything except deduction of the marks. So starting from this slide, send down. So this is the last part which we have to done. Triage. The answer of the triage is here for you. So in person, if you wanted to ask anything about the triage, you can ask it immediately, or you can ask it on the WhatsApp group. I have answered number of queries of the students last night and today even in the morning on the WhatsApp. So this is the balance sheet and this is the adjusted profit. So one of the student has adjusted a triage. I can show you here. I think here's not attempted. Okay, triage. Yes, this is again a type of script I have received. So if you do not prepare the financial statements, so your working is useless. So mostly students I see are good in the working, but they're not up to the mark in terms of the presentation of the financial statements. Uh, Triage. So these are some scripts. I will discuss the remaining scripts later. So let's start from this slide. Send down, brand. Okay. Today we'll discuss all the notes of the triage. So you don't have to worry about the send down and triage. Okay, let's start. Brand 1st October 2005 has got the value of 30,000, and this brand has up to now has been depreciated or amortized by 9,000. Sandown's brand and trial balance relates to the product line that received bad publicity during the year, which led to a falling sales revenue. An impairment review was conducted on 1st April 2009. 1st April 2009 is the date. The financial year of the company starts from 1st October 2008. So definitely it will end on 30th September 2009. And the company has done an impairment review at the mid of the year. That is on 1st April 2009. And the book value of the asset at the start of the year is 21,000 by deducting 30,000 and 9,000. Okay. An impairment review was conducted on 1st April 2009, which concluded that based on the estimated future sales, the brand had a value in use. The brand had a value in use at this date is 12 million, and the remaining life is only 3 years. However, on the same date, the impairment review, the Sandown received an offer to purchase the brand for 15 million. So actually, the net selling price of this brand is 15 million. So recoverable amount should be the higher of net selling price and value in use. So the recoverable amount should be 15 million. Sorry. So first of all, we have to charge a depreciation for the first 6 months to calculate the net book value at the mid of the year. So, and the company is charging the depreciation over 10 years. So the cost of the asset is 30,000 divided by 10. We got the value of 3,000 for the year, and for the first 6 months it will be 1,500. So the net book value at the mid of the year will be 19,500, and its recoverable amount is 15,000. That means there is an impairment loss of 4,500, which should be reported in the income statement. Do remember this point. It should be reported in the income statement rather than in the statement of comprehensive income. Okay. And for the last 6 months, this asset should now be measured at the 15 million, and the remaining life of this brand is now 3 years. So the amortization for the last 6 months will be 5,000 into 6 of 112. We got the value of 2.5. So the income statement, the amortization expense will be 1,500 plus 2,500, and there will be an impairment loss of 4,500. So if we are charging the amortization in the cost of goods sold, then its impairment loss should also be charged in the cost of goods sold. So this is the adjustment of send now note number 7. So if you have any question, you can ask it immediately. Uh, Impairment, yes. Favorable cost to sell. Where did the 2,500 comes from? Actually, the asset was impaired at the mid of the year, and at the in mid of the year after the impairment, the value of the asset is now 15 million. And the question says you that after the impairment, the life of the remaining life of the asset is just 3 years. So for the last 6 months, we calculate the amortization by dividing 15,000 by 3. We got the value of 5,000 for the year, and by multiplying it with 6 upon 12, we got the value of 2,500 for the last 6 months. Why the 10 years wasn't used instead of 3 years? Actually, the question says that initially the asset was amortized over 10 years, but after the impairment, there is a significant decline in the useful life. This is called the change in accounting estimates. So it is a change in the useful life. So if the company has revised its useful life, you have to calculate the amortization or depreciation accordingly. Now, calculation of 1500. The 1500 is calculated for the first 6 months by using the value of 30,000 over 10 years useful life. So by dividing 30,000 by 10, we got the value of 3,000 for the year, and by multiplying with 6 upon 12 for the first 6 months, we got the value of 1500. Okay. The impairment losses to be included in cost of goods sold or admin expense. The impairment losses should be included in the cost of goods sold if we are charging its amortization in cost of goods sold. Impairment loss of 4,500, how it is calculated? It is the difference between the net book value, which is now 19,500, and the recoverable amount, which is 15,000. So by taking the difference of 19,500 and 15,000, we got the value of impairment loss. Okay. So next, here we have the answers of triage company. So if you have any question about the triage, you can ask on the WhatsApp. Okay, again, why we are dividing the 15,000 by 3 years? I have already told you before that if the question is saying to you that after the impairment, the life of the asset has been reduced to 3 years. So we have to recalculate the depreciation over its remaining useful life. So if the question is clearly saying to you that the remaining life is just 3 years, so you have to calculate depreciation over 3 years. Okay, non-current asset held for sale. Held for sale assets should not be reported in non-current assets. Rather, it should be reported with current assets. So assets which are classified as held for sale should be removed from the non-current asset and should be reported separately with the current assets. Once we have placed the assets under the held for sale category, there should be no depreciation on these assets. So no depreciation will be charged on the assets classified as held for sale. Number one. The second most important point is when we are classifying the assets into held for sale, the asset should be measured at the lower of net book value and fair value less cost to sell. So if the net book value is 100 and the fair value less cost to sell is 60, so asset should be reported at 60. And the difference of 40 should be charged in the income statement as an expense. This loss is also called impairment loss. And this asset should be reported in held for sale category. But there are some points that should have to be met in order for an asset to be classified into held for sale. These are, number first one is management must be committed to the plan. The asset must be immediately available for sale. There must be an active program to locate the buyer. The sale is highly probable and should be completed within 12 months. The asset is being actively marketed at its reasonable price, and actions required to complete the plan indicate that it is unlikely that the plan will be significantly changed or withdrawn. So if the company is committed to sell this asset, then then we have to transfer the non-current assets into held for sale category. There is no option to download the PDF files for today. Okay. The location for this loss of impairment. Uh, the impairment loss of this held for sale should also be reported in the cost of goods sold. But if we are going to dispose of group of assets in a single transaction, then this is technically called disposal group. The measurement and the calculation for the disposal group is similar to held for sale, but once there is an impairment loss in a disposal group, it should be allocated according to the provisions of IS 36. Like the first one should be obvious impairment, the second priority should be given to impair goodwill, and the third one should be pro rata. These are some important points for you to read at home when you are doing the practice of IFRS 5 questions. Okay. The second part of the IFRS 5 is relating to the discontinued operations. It says that if the company is going to discontinue its operations in the near future, it should be reported separately. Like the sales initially should be reported for the continued operations only, the cost of goods sold for continued operations, gross profit for continued operations, expenses for continued, profit for continued, and the profit or loss from the discontinued operations should be added or subtracted separately at the end of this statement. And then we calculate the profit for the year or loss for the year. So if the company is going to dispose of or going to disclose down its operations in near future, that is 1 year, then it should report the results of the discontinued operations separately. So let's start the question. The, the above balances contain the result of the Terminet's car retailing operations. So the balances given to you is relating to one of the operations of the company that is relating to the car retailing, which ceased on 31st December 2002. due to mounting losses. The result of the car retailing operations, which is to be treated as a discontinued operations. So actually, the company is going to shut down its operations relating to the car retailing in 2002, December 2002, and we are preparing the financial statements on 30th September 2003, means in the current year. So we should have to report the results of the discontinued operation separately. Like when we report the sales in the income statement, we should have to deduct 15,200 from the sales because this sales is related to discontinued operations. When we are calculating the cost of goods sold, we have to deduct the cost of goods sold of a discontinued operation. And similarly, from the operating expenses, we have to deduct 3,200 because the calculation of the discontinued operation should be dealt with separately. So when we calculate the profit or loss on the discontinued operation, the revenue of the discontinued operation is 15,200, the cost of goods sold is 16,000, and operating expenses is 3,200. So actually, we are suffering a loss in the discontinued operations, and which is amounted to 4,000 loss. The operating expenses are included in the administration expense in the trial balance. The terminate is still paying the rental for the lease of its car showroom. The rentals are included in the operating expenses. Terminate is hoping to use the premises as an expansion of its administration office. This is dependent on obtaining the planning permission from the local authority for the change of the use. However, this is very difficult to obtain. So it is impossible for the company to use the showroom for business purpose or administration purpose. Secondly, however, it is very difficult to obtain. Failing this is the best option would be early termination of the lease, which will cost 1.5 million in the penalties. This amount has not been provided for. So company should have to provide for 1500 further because this is again the amount of the loss that the company should have to bear. So the total loss for the company will be 5,500. So when we prepare the financial statements of the company, you have to report all the figures from the continued operations and the single amount of loss from the discontinued operations should be deducted from the profit for the year from continued operations. Then we got the value of total profit. If there are consolidations, should these be removed from first before the proceeding with onward computation? Yes. Now, again, we have a question for you that is related to Dune. So I'm giving you just 1 minute to solve this question and write your answers in the chat box. So let's start. On 30th September 2013, we have been given a property with a cost of 45,000 and its accumulated depreciation is 6,000. So the book value at the start of the year is 39,000. And on 1st April 2014, Dune decided to sell this property. So company is deciding to sell this property on 1st April 2014, means after 6 months. So first of all, you have to charge a depreciation for the first 6 months, which is for which we have to use 15 years. So by dividing 45,000 by 15, we got the value of 3,000. And for the first 6 months, there will be a depreciation of 1,500. So the net book value will be 37,500. Now, the property is being marketed by the property agent at a price of 42 million. So the selling price is 42 million, which was considered a reasonable achievable price at that date. The expected cost to sell is 1 million. Recent market transactions suggest that the actual selling price achieved for this type of the property in the current market conditions are 10% less than the price at which they are marketed. So the reasonable price for this asset will be 10% less. So when we deduct 42 and 4.2, we got the value of 36.8, 37.8. 30, am I right? Yes, it's 37.8. So the fair value less cost to sell is 37.8, but its net book value is 37.5. And IFRS 5 says that the asset should be reported at the lower of fair value less cost to sell and its net book value. So if this asset should be reported at 37.5 million. Okay. Any question? Why was the accumulated depreciation not subtracted from the 45 million? I have already subtracted accumulated depreciation from here. Also deduct the cost to sell from the revised fair value. Yes, we have to deduct. Oh, I think we have done a mistake. We have to deduct the cost to sell. That is 36.8. Sorry, it's a mistake. Please accept the apology. Yes, the book value is 37.5 and the fair value less cost to sell is 36.8. So the right answer for this question is C actually. How the fair value been find? It's already mentioned in the question that the fair value is 10% less than this value 42. So I have deducted the 10% amount of 42. We got the value of 37.8. That is the fair value of the property, and the cost to sell is 1 million. We got the value of 36.8. So C is the right answer. And the difference will be recognized as an impairment loss. Here is another question for you. I'm giving you just 1 minute to please solve the question and write your answers in the chat box. Try to solve this question and write your answers in the chat box. So let's start again. The carrying amount on the 1st April 2014 is 800,000, and on 1st October 2014 means after 6 months, company has decided to sell this property and classify the asset into held for sale category. The property agent reported that the property had a fair value less cost to sell. So the fair value less cost to sell is 790,500, and the book value is 800,000 divided by remaining life of 16 years. The depreciation will be 50,000 for the year, and for the first 6 months it will be 25,000. So the book value is 775,000 and its fair value has cost to sell 790,000, so it should be reported at the lower value. So the right answer is A. Great. So let's start the new standard, that is IFRS 15. IFRS 15 is actually the updated version of IS 11 and IS 18, and this standard has superseded these two standards, IS 11 and IS 18. And according to IFRS 15, all the revenues should be recorded in accordance with IFRS 15 using these 5 steps. So the first step is to identify the contract with the customer, whether there is a contract with the customer and the supplier exists or not. Second condition is what will be the performance obligations in the contract. You should have to identify, then determine the transaction price, then allocate the transaction price to each performance obligation. For example, I have to sell A and B at the same time, and I'm charging a single price for these two products, so I have to allocate the price on both of the products separately, and recognize the revenue when the entity satisfy the performance obligation. So the revenue can only be recognized when the company has recognized the revenue when the company has delivered its performance obligation. Then it can recognize the revenue even if the company has not yet received the cash. Like we do record credit sales by debiting the debtors and crediting the sales account. So we record the revenue without receiving the cash. So the accounting does not believe on the cash. It totally focus on accrual concepts. So this is the key uh, provisions of IFRS 15. So let's start with some practice. So revenue includes an amount of 16 million. So the revenue of the company includes an amount of 16 million for the sale on 1st April 2015, the sales related to the single product, and includes an ongoing service cost. So the company has made a sales of 16 million in which the company has sold the goods and some services. Services for 4 years. The normal selling price of the product and the service would be 18 million for the goods and 500,000 per annum, 2 million for the services. So actually 18 plus 2, it will cost an individual to purchase these two items separately at a value of 20 million. But the company is giving the package and it's selling its goods and services at a discounted price of 16 million. So as IFRS 15 says, identify the contract. So there is a complete contract. You can see here there is a sales related contract. Identify the performance obligation. Performance obligation is company has to deliver goods and services for the 4 years. Then identify the transaction price. The transaction price is 16 million. Then step 4 is allocate the transaction price to each performance obligation. Allocate the transaction price to each performance obligation. So we have to allocate the transaction price on pro rata basis. So by taking the weightage of 18 upon 20 of 16 million, we got the value of the goods. So 18 divided by 20 multiplied by 16, we got the value of the goods is 14.4 million. And the remaining value will be for the services. So it will be 0.6 for the services. So the company can recognize 14.4 million immediately when the company delivers the goods, because IFRS 15 point number 5 says that then you can recognize the revenue when the performance obligation is satisfied. So the performance obligation for the goods is that once you have delivered the goods, so it will be recognized immediately. It will be 1.6, sorry. And for the services, it should be recognized gradually over the period of 4 years. So 1.6 million should be spread over 4 years. So the revenue for the first year should be 1.6 divided by 4. We got the value of 0.4. But as the question says that we have received the full amount, then the difference of 1.2 will be recognized as deferred income. So out of 1.6, company has earned 0.4 million in the first year, and the remaining 1.6 million, 1.2 million advance will be reported as unearned income or deferred income in the liability section. So the income statement sales should be reported with 14.4 plus 0.4 for the service. And in the balance sheet, there will be a deferred income of 1.2 million. 1.2 million will be in the non-current liability? No. 1.2 million should be reported in liability section, out of which company has to settle 0.4 million in the near future. So 0.4 should be reported in current liability and 0.8 should be reported in non-current liability. Where did we find 4? 4 from? The 4 is actually mentioned here. You can see here. The 4 is mentioned here that the service should be for a period of 4 years. Any question? Yes. The second question of IFRS 15 is relating to construction contract. Dugan Company entered into a contract where the performance obligation is satisfied over time. The price of the contract is 9 million and the total expected cost is 5 million. So all you need to do for construction contract is to write total revenue of the contract in your working, that is 9 million, and the total cost of the contract is 5 million, and the total profit of the contract is 4 million. The second step is to identify the percentage completion. The progress towards the completion was measured at 50% in 2007 and 80% in 2008. The correct entry were made in the year ended 30th June 2007, but no entries have been made for the year ended 30th June 2008. So for 2007, the company has earned 50% of this amount, that is 4.5, 2.5, and 2. And for 2008, the cumulative amount will be 80% of 9 million. So it will be 7.2. 80% of 5 million, it will be 4 million. And the cumulative profit that the company has earned till this date is 3.2. But in the income statement, you should have to report what the company has earned in this 12 months only. So in this 12 months, company has earned the revenue of 7.2 minus 4.5 revenue. The cost that the company has incurred in this period is 4 minus 2.5, and the profit that the company has earned in this period is 3.2 minus 2. So these are the figures which you can use in the revenue, cost of sales, and the profits. So if you have any question, please do ask it immediately so that any question from the students, please write in the chat box if you have any question. Okay, let's move on. The question is, what about the contract asset? There is no adjustment of the contract for the contract asset because the question is related to the income statement portion. It will only tells you about income statement extract. How come the revenue has increased and the cost have decreased? The revenue has increased and the cost have decreased. No, both is increasing actually. 4.5 to 7.2 and 2.5 to 4. So the revenue should be 2.7, the cost should be 1.5, and the profit will be the difference. Okay. So you have to book the revenue with 2.7, you have to book the cost with 1.5, and the difference will be the profit. Now, again, there's a question for you. The construction contract balance represent cost incurred to date of 35 million, less progress billing received of 30 million on a 2 years contract that commenced on 1st October 2003. The total contract price have been agreed is 125. So first of all, you have to note down separately what will be the total price of the contract, and it's mentioned here it's 125. The second task is to identify the total cost of the contract. Why are you subtracting 50% figures from the 80% figures? Actually, company has uh, done the work of 50% in the first year and the cumulative figure of 80% till the second year. So the additional work that the company has performed in the second year is actually 30%, which is the difference between 80% and 50%. And we have to report in the income statement only the figures which we have earned in the current 12 months. Okay. Now the total cost of the contract. The Chamberlain expect that the total contract cost to be 75 million. So the total cost of the contract is 75 million. So the difference will be the profit. So the profit is 50 million. The company policy to accrue for the profits on uncompleted contracts by applying the percentage of completion to the total estimated profits. The percentage completion is determined by the proportion of the cost incurred, contract cost to date, compared to the total estimated contract cost. At 30th September 2005, 5 million of the 35 million costs were incurred on that date related to the unused inventory of the material on the site. So all of you are required to calculate the percentage completion in this question. Can you calculate the percentage completion of the contract in this question? Please write your answers in the chat box. What is the percentage completion? 14%. One of the students saying the percentage is 14%. The second answer 46.7, 46.7, 14.29, 14.29, 46.7, 28, 35, 75%. Different answers. So the right answer of this question is 40%. This is actually the reason I want all of you to calculate the percentage. Now the question is how? The formula that we should have to use is actually based on the cost. The percentage completion is determined the proportion of the contract cost to date. So in the numerator we have to show the contract cost incurred to date divided by total contract cost. The total contract cost is 75 and the company has incurred up till now 35 million, out of which 5 million is unused inventory. It means we have purchased the material but we have not yet utilized it on the construction contract. So on the contract we have actually incurred 30 million out of 35. So the percentage should be 30 upon 75. So when we are dividing 30 by 75, we got the value of 40%. So we have earned 40% of the revenue. We have to book 40% of the cost and we can recognize 40% profit. So it should be 20. Then it should be 125 into 40%. It should be 50 and it should be 30. So in the revenue, we should have to report 50 million. In the cost of sales, we have to book the cost of 30 million and the difference will be the profit that should be reported in the income statement. Now, as far as the balance sheet is concerned, we have to take the cost incurred to date. The cost incurred to date is 35 million plus the cumulative profit that we have earned to date is 20 million and company has received the progress billing which is 30 million. So this is the contract asset or the amount due from the customers. Uh, Even company has not yet received a single amount of the cash. You can book the revenue by 50 million because of the fact that accounting always focus on accrual basis of accounting. So if we have delivered our performance obligation, then we can recognize the revenue of that portion. So the amount should be 25. So this 25 should be reported in current assets under the heading with the heading of amount due from customers. Now here is another question for you. I want all of you to please solve the question. I'm giving you just 1 minute to solve. Okay, what is the total amount which the Hindenburg should credit to the profit and loss in respect of this transaction? So what should be the revenue of the company? Hindenburg is a car retailer. On 1st April 2014, Hindenburg sold a car to Letterly on the following terms. Selling the price of the car was 25,300, and immediately company is going to receive 12,650. That is the half amount, and the remaining half amount will be, and on 1st April 2014, and would pay the remaining half amount on 31st March 2016, means after 2 years. And for the revenue to be recorded, there will be a cost of capital of 10%. So in this transaction, how many performance obligation that company has in this contract? If the company has only one performance obligation, or the company has two performance obligations? Do you people have any idea whether the company has one performance obligation or have two performance obligations for this case? So the answer is the company has two performance obligation. Company is actually selling a car and at the same time selling a credit facility to its customers. So for recording purpose, the accounting entry should be cash debit by 12,650, receivables debit, and sales credit. And receivables should be debited with the present value of this amount. So 12,650 into 1 plus 0.10 raised to the power minus 2. So can you do the calculation? 1.10 raised to the power minus 2. We got the value of 10455. So receivable should be debited with 10455, and the sale should be reported with this gross amount, 126,550 plus 10455. So the amount should be 23105. So this should be the revenue that we should have to recognize at the start of the contract when the company has delivered the car. That is on 1st April 2014. And this amount should be amortized over 2 years. So the company should have to record this with the using the amortization table, like receivables at start, then finance income minus receipt is equals to receivables at end. So the receivable at the start for this portion is 10455 plus finance income. Finance income should be based at 10%. So 1045, and there is no receipt in the current year, and this will be the total receivable amount. So in the income statement, the total amount that should have to be reported is 23105 plus 1045. So the right answer for this question is D, 24150. Okay. So can you repeat the double entries again? Double entry is cash should be debited by 12,650 and receivable should be debited with the present value of the future cash flows. So actually we have to pay 12,615 after 2 years time, and the cost of the capital is 10%, therefore it should be recorded at its present value. So the present value of 12,650 is 10455, and sales should be credited with this amount. And for this credit facility we have to book the finance income on annual basis. So finance income for this 10455 is 10% of this amount, which is 1045. So by adding these two values, we got the value of 24150, that is D. Why not finance? We're not considering 1 year. No, actually, the company has given 2 years time for the repayment. So therefore, we have to take the 2 years initially. And at the reporting date, there will be one more year left. No, we cannot use 1 year because we are calculating and recording this double entry on 1st April 2014. So from this date, there are actually 2 years. You are counting actually from the reporting date. Where is the 10% return? 10% is written here. This 10% should be used for the present value calculation, and it should be used for the finance income. Okay. One more case of IFRS 15. This case is actually one of the case of substance over form. And it says that when the company has made a sale and repurchase agreement, then the whole amount should be reported in the loan. And whenever there is a loan, there should be a finance cost, and the closing inventory should be added in the closing, and the cost of the stock should be added with the closing stock. So uh, I'm again repeating the accounting treatment is whenever the company has made the sales and repurchase agreement, then the whole amount should be reported in the loan. Whenever there is a loan, there should be a finance cost based on the time period, and the cost of the inventory on sale or return basis should be added in the closing stock. Okay, so the accounting entry should be cash debit and loan credit. And for this loan, there should be a finance cost, and the cost of the inventory should be added in the closing stock. It means that we are assuming that the company has not yet sold this stock because the risk and rewards of the stock has not been shifted. So whatever we have received the cash against the stock should be reported as a loan. So the revenue includes 3 million. So company has already included this amount in the revenue. So that accounting entry should be debit revenue, because you cannot record the revenue when the company has made the sale with return facility and repurchase facility. The revenue includes 3 million sales made on 1st January 2015 for maturing goods which are not biological assets. The carrying amount of these goods at the date of the sale was 2 million. The Mostyn is still in the possession of the goods, have not been included in the inventory count, and has an unexercised option to repurchase them at any time in the next 3 years. In the 3 years' time, the goods are expected to be worth 5 million, and the repurchase will be the original selling price plus interest. So on 1st January, company has sold the assets. So the accounting entry or adjusting entry for this 3 million should be revenue debit and loan credit. And company should have to record the finance cost or the interest cost at 10% of this 3 million. So assuming if the financial year of the company ends on 31st December, then there should be a finance cost of 0.3 million. And the closing stock of this stock that is 0.2 million. The cost of this stock. The cost of this stock that is 0.2 million should be included in closing stock. So in this question, the closing stock data is missing, but whatever be the closing stock, the cost of the sale or return should be added in the closing stock. Uh, biological assets means plants and animals. So the question is clearly showing that the goods are not biological assets. It means the transaction is outside the scope of IS 41. Let's move on. Sale or return basis. Turbulent note number 1. For the sale or return basis, you cannot record the revenue on sale or return basis. All you need to do is to reverse the revenue that the company has recognized by debiting the revenue and crediting the debtors account. And again, the cost of the sale or return basis should be added in the closing stock. Last slide. This student wants the last slide. Okay, let's move on. Sale revenue includes 50 million which the company has made on the sale or return basis. So the company has already recorded 15 million in the sales revenue. So the accounting entry should be 50 million sales debit and debtors credit. So both the debtors and the sales revenue should be adjusted and reversed when the company has made the transaction on sale or return basis. A gross profit margin of 40%. So this 40% will be used to calculate the cost of the inventory. The cost should be calculated by dividing, as it says it's some 40% margin by 100 multiplied by 60. We got the value of the cost of this inventory. This cost should be included or added in the closing stock because the customer has not yet confirmed that will pay for the goods or not. But if the question says to you that the customer is willing to purchase half of the goods, then you only have to adjust the remaining half because the customer is giving its confirmation that he or she willing to accept the goods. But until we got the final confirmation from the customer, we have to reverse the revenue and the debtors, and the cost should be added in the closing stock. So if you have any question in this part, you can ask immediately. Otherwise, we have to move forward. Okay. The next part is the commission sales. The commission sales adjustment in the final account says that whenever you are working as an agent on the behalf of your principal company and you are making the sales of your principal company on a commission basis, then you can only recognize the commission portion of your revenue. Suppose A company has sold the goods to B company with the value of 500,000 and A is working as an agent in this transaction with a 10% commission. So A can only recognize the revenue of 50,000, that is 500 into 10%. But A, being an agent, cannot record the sales of 500,000 because this 500,000 is the sales of the principal company. So being an agent, you cannot record the sales of the principal company. You can only record your commission income. Okay. Now, revenue includes an amount of 20 million for the cash sales made through Extol retail outlets during the year on the behalf of the franchise company. So actually, the company with the name Extol is making the sales on the behalf of the franchise company. This is the principal company, and Xtol acting as an agent, and you are only entitled to receive the commission of 10%. So 20 million into 10%, you are only entitled to receive the commission income of 2 million. But the company has already recorded 20 million in its revenue. So all you need to do is to reverse the revenue amount and only record the 2 million in the income statement. Xtol had remitted 15 million to the franchise of the 20 million sales and recorded this amount in the cost of sales. So company is pretending and showing that we are purchasing the goods for 15 million and selling it for 20 million. Therefore, company has charged the 15 million in cost of sales, and which is totally a wrong reporting. The correct reporting is you are a commission agent. You can only recognize the 2 million commission, and the amount that you have received in advance is your liability, which should be transferred to the franchise company. So what should be the adjustment? The adjusting entry should be revenue should be debited by 18 million, because out of 20 million we can only record 2 million. So 2 million is my commission income, and I have already recorded this amount. So revenue should be reversed with 18 million, and the cost of goods sold should be reversed with 15 million, and the difference of 3 million will be considered as a payable in the books of Xtol company to Francis company. So this should be the adjusting entry for this transaction. The question, okay, very good. Will we reverse 18 million? Yes, we have to reverse 18 million. Why we are reversing? We are reversing because the company has recognized the revenue of its principal company. And as we are working as an agent, so we only have to record the commission portion rather than the sales revenue of the principal company. Okay. So let's take a break of 10 minutes. Tea break. So stay connected. I'll be right back after 10 minutes. Thank you very much. Okay, welcome back. Uh, so let's start with the adjustment of substance over form, that is relating to factoring. Factoring means company sells or sold its debtors to a third party, that is the factoring company, and the recovery process from the debtors will be dealt with by the factoring company. So the benefit to the company is that the company will receive the immediate 40 to 50% payment and the remaining after the recovery. Now, as you all know that the debtors is connected with the risk, that is bad debt. So the question is, who is going to bear the risk of loss? Loss due to bad debts. The one arrangement is whatever the loss of the bad debt will be should be bared by the company, and it could be a factoring company. Factoring company charge its commission for these two types of services. So the first service is factoring company. It's we are selling its customers or debtors to the factoring company, and factoring company has paid the immediate amount to the company, but the risk of the bad debt will be bared by the company. So the accounting entry in this situation should be cash debit and loan credit. And whenever there is a loan, there will be a finance cost. So you cannot de-recognize the receivables. Instead, you have to record the loan amount. Secondly, if the risk of the bad debt will be bared by the factoring company, the accounting entry for the receipt from the factoring company will be debtors, your receivables, debtors or receivables credit. So this is the basic difference between with recourse and without recourse factoring. With recourse factoring means the bad debt will be bared by the company, and without recourse means the bad debts will be bared by the factoring company. So there is a clear difference between these two accounting entries. An examiner will always ask this type of adjustments, as you can see in the exam kit question, that is Highwood. But whenever the examiner will give you the question, examiner always record this transaction by debiting the cash and crediting the debtors. So all you need to do is to reverse the debtors amount and record the loan instead of the debtors, and recognize the finance cost according to the time period. So this is the basic treatment of factoring according to the substance over form. Okay, there are some students who want me to repeat the factoring. Factoring is actually the process in which the company sells its debtors to the third parties, and the third party will be collecting the cash on the behalf of the company and charging the fee on the total receivables. So the factoring company is actually a commission agent that works for the company, and it purchase the data of the company and work on the recovery process. But whenever we sell our data to the third party, there will be always a risk of bad debts. So there are two type of arrangement. The one arrangement is the bad debt will be beared by the company, and the second arrangement is bad debts will be beared by the factoring company. So if the bad debt will be beared by the factoring company, then the accounting entry should be cash debit and data credit. And if the bad debt will be beared by the company itself, then the accounting entry should be cash debit and loan credit. So whenever examiner will give you the adjustment of the relating to the factoring, always keep this in mind that the examiner has already de-recognized the data's amount. So all you need to do is to reverse the datas and record the loan instead of the datas. So the adjusting entry should be debiting datas and crediting the loan account. And then you have to book the finance cost according to the time period. Next. Yes, this one is relating to in both situations the agent fees will be different. Yes, agent fee will be different. Agent fee will be different for both the cases. Okay, someone wanted to take the screenshot of this. Okay, IFRS 16. Under IFRS 16, we have to record the right to use the asset by debiting the right to use the asset and crediting the cash with the initial deposit, and we have to credit the lease obligation with the present value of future cash flows. And this lease obligation will be amortized using the amortization table, and this right to use the asset should be depreciated at the shorter of lease period and useful life of the asset. Does the examiner always de-recognize the data? Yes, the examiner will always de-recognize the data which is the wrong treatment, and you are required to you should have to require you should have to reverse the data's amount and credit the loan amount. Okay, sorry. uh, Again, starting IFRS 16. So for IFRS 16 cases, you should have to record the right to use the asset by debiting the right to use the asset and crediting the cash if the question says it has an initial deposit and lease obligation with the present value of the future cash flows. Lease obligation will be amortized over the life lease period, and the asset will be depreciated at the lower of lease period and or useful life of the asset. Okay, so let's start the question. On 1st October 2003, Chamberlain purchased an item of the plant on lease terms for 56 million. So the accounting entry will be right to use the asset or plant debit by 56 million, and the lease period is for 4 years with an annual rental of 16 million, and there is no initial deposit. So there will be no cash initially, and the lease obligation should be with 56 million. So this should be the initial entry for this lease arrangement. Now, this lease obligation should be amortized using the amortization table, like obligation at start plus interest at 10%, which is 5.6 minus payment of 16 million We got the obligation at end. So 56 million plus 5.6 million minus 16 million. There will be a value of 45.6 million. So for all the lease cases, when the questions tell you that the payment will be made in arrears, you should have to build this table. And whenever the questions tell you that the payment will be made in advance, like in this question, the first payment will be made in advance, then the table should be obligation at start minus payment first, then interest, then obligation at end. So this should be the table in case of the payment is made in arrears, and this should be the table if the payment was made in advance. So for the first payment which is made in advance, the interest will be calculated after deducting the payment. So the 10% interest will be calculated at this way. So the obligation at end will be 44 million. Okay. So I have discussed both the models. The first one is for the arrears, the second one is for the advance. And this asset should be depreciated over the shorter of lease period and useful life. The lease period is 4 years, but the useful life of this asset is 6 years. So it should be depreciated over 4 years. But there is a important point that you should have to remember and understand, that in a lease arrangement, if the question tells you that the asset will be transferred to the lessee at the end of the lease period, then this should be depreciated over its useful life. If the asset will be transferred to the lessee at the end of the lease period, then this asset should be depreciated in all the cases at its useful life. Here, there is nothing mentioned that the company is going to purchase the plant after 4 years, or the company has uh, to reverse the plant to the leasing company. So it is better to depreciate this plant over the shorter of lease period and useful life. So we have to calculate the depreciation at 56 divided by 4. So this should be the depreciation. Finance cost should be 4 million for this situation. And this obligation should be split between current liability and non-current liability. And the current liability in advanced cases will be the installment always. Do remember this point. The current liability in case of advance payment will be the installment amount. And the non-current liability will be the differential amount, that is 28. Now the question is, how do we calculate 4 million interest? 4 million interest is calculated after deducting the 16 million because the payment was made at the start of the lease period. So 56 minus 16, it will become the obligation of 40. So effectively we have utilized the loan from the leasing company with the value of 40 actually. So we have to pay the interest at this amount. What we have added in the payment second equation? Why have we added payment in the second equation? We didn't add the payment. We have just subtracted the payment. how you take 44 as current liability. 44 is not a current liability. 16 is the current liability, because out of 44, the company is going to receive 16 million in the next year. So whatever amount we have to receive in the next 12 months should be considered as a current liability. So out of 44, 16 million is the current liability, and the remaining difference will be considered as a non-current liability. In this question, the requirement is advance payment method, yes. And if the property is returned to the lessee after the end of the lease period, it should be depreciated useful life, yes. Lease, LO means lease obligation. Okay, besides, how do we treat the low value assets? IFRS 16 ignores uh, the calculation of low value assets. All the low value assets should be charged as an expense in the period in which it has incurred. So there is no need to apply the lease accounting on low value assets according to IFRS 16. Also in area the current and non-current liability. Okay. If for the area situation, obligation at start is 56, interest will be 5.6, payment will be 16 million, and obligation at end will be 45.6. You are required to perform the calculation of one more year for the purpose of calculating the current and non-current liability. Minus 16 million. So if I'm not wrong, 456 million plus 5.6 million minus 16 million. 45.6 plus 4.56 minus 16 million. We got the value of 34.16. So for the area situation, the easiest way is to calculate the table for one more year, and out of 45, 34.16 will be considered as a non-current liability, and the remaining difference will be considered as a current liability. So if we have not yet been able to pay 34.616 till the next year, then it means it will be paid later on. Then this amount should be reported as a non-current liability, and the differential between these two liabilities should be considered as a current liability. So the easiest way to calculate the current liability is to prepare the table of one more year. What about if you have the lease period and useful life? The asset should be depreciated at the lower of lease period and useful life. Okay. I think you should have to move forward. Any question? Okay. Uh, according to the monitor, I can see that there are a number of students who are taking the session, but they have not yet submitted the assignment. So believe me, this session will not going to pay you any benefit and give you or give you any benefit if you are not focusing on the practice. And I can give you, and I'm giving you the favor to the students that I'm checking the answer script of each and every single individual. So it is highly requested to all of you to please submit your assignment if you wanted to pass the exams. Otherwise, There are some students who got failed in the examination and who have no knowledge that how and why they are failed, because they think that they know each and everything, but the result is worst. So it is highly requested to, I have shared number of times the WhatsApp group, uh, my number on the for the WhatsApp and my email address, but I am not getting the solutions or assignments for the students who are taking the session. So it is highly recommended to all of you to please do submit the assignment and do the maximum practice. These slides are actually worth millions of dollars for you at this stage. This is actually these slides are actually summarized financial reporting slides or F7 slides, and I have selected these standards because these are relevant for this session, March 2019. So it is highly requested and recommended to please attempt the questions and do not take this paper uh, easy and taken for granted. Okay. If the payment are made in advance, which value? Which value? If the payment are made in advance, then the installment amount will be the current liability. In some question, I have seen that in some questions I have seen they take the first year amount as non-current liability, right to use assets. In some questions, I have seen that they take the first year amount. Yes, I'm telling you, the first year amount should be reported between current and non-current liability. But how you can calculate the simple amount? Actually, you are confusing between leasing amortization table and other standards. So when you are doing the leasing amortization table, there should be a distinction between the current and non-current liability. Okay. Right to use the assets? Question mark. Should we depreciate? Yes. What is the current liability of the second year? What is the current liability of the second year? Okay. When we are preparing the financial statement for the second year, the finance cost should be 4.56, and for the second year we have to prepare the table for the third year actually. Then we have to charge the interest 3.46, then payment and obligation at end. So the difference between these two amount will be the current liability out of 34.16, and the remaining amount will be the non-current liability. So in order to calculate the current and non-current liability, you have to do the working for the next year at least in situation in case of areas. Okay. Sir, 45.6 and 34 different current liability. Yes, the difference between 34.6 and 45.6 will be considered as the current liability, and 34.6 will be considered as a non-current liability for year 1. Okay, can we please send the today's assignments tomorrow? I had my IELTS exam today, so I could not do it. Okay, you can send it by tomorrow, even till Saturday. You can send it the assignments, and I will check and reply you accordingly. I didn't attend the yesterday session. What was the assignment? Assignment was shown in the handout section. You can see on the right hand side there is a handout section in which there are two documents. One uh, is related to the PowerPoint slides, and the second is the Word document. And in the Word document, I have given two questions, that is triage and send down. These two questions can also be available in past papers. You can even attempt it from the past paper. Secondly, it's very important for all of you to please uh, try to memorize the key concepts that I have shown in the PowerPoint slides, and the question we did in day 1 and day 2 should be repeated till the exam date. Installment less interest. Yes, it's right. So can you send tomorrow's lectures topics? Yes, the tomorrow's lectures topics. For tomorrow, we'll be discussing the consolidation topic. So we will be focusing on the consolidated balance sheet and consolidated income statement. Okay. I can't see the shared screen. I can access the assignment document. Okay, assignment document. You can see on the right hand side of the screen there is a handout section in which from which you can download the Word document of day 1 and day 2. Okay, so let's start and move towards the next slide. IS 37 is also one of the important standard according to the examiner. The accounting entry for the provision should be income statement debit and provision credit. And if the provision is related to dismantling or site restoration, the accounting entry should be asset debit and provision credit. So at maximum there could be two entries for the provision under IS 37. But in order to record the provision, there must be three criteria that should have to be met. The first one is there must be a present obligation arises from the past event. Outflow of economic benefit should be probable, and the amount can be measured reliably. If these 3 points are met, then we can recognize the provision. Otherwise, the amount should be disclosed in notes to the accounts as contingent liability. Okay. But if the company is going to receive the compensation for the loss it has already incurred, then the compensation from the third party or some sort of reimbursement can only be recognized when the chances is virtually certain. So the asset can only be recognized at the percentage of 95% plus, but the liability can be recognized at 50% plus. That means probable situation. Okay, so let's start. On 1st January 2008, Duggan was notified that an ex-employee had started court proceedings. Ex-employee has started court proceedings against them for the unfair dismissal. So, on the basis of unfair dismissal, ex-employee has filed a suit against the company. The legal advice was there was an 80% chance that the Duggan would lose the case and the company would have to pay the estimated of 1.012 million in January 2009 after 1 year. Based on the advice, Duggan has recorded a provision of 800,000 in January 2008 and has made no further adjustments. The provisions were recorded in the operating expense. Duggan has a cost of capital of 10% per annum and the discount rate for the first year is 0.909. So by multiplying 1.012 into 0.909, can you calculate the amount? What will be the answer for this? It's 920. So provision should be recorded with this amount. So the accounting entry should be income statement debit and provision credit by 920 initially. And you have to record the unwinding of discount of this 920 figure. So 920 into 10% should be the unwinding of discount for this question. The unwinding of discount should be charged in the finance cost. I hope it's clear. Actually, this figure is in millions, and if you wanted to report this figure, it will be 0.92 million. So you can write 920K or 0.92 million. It's totally fine. Okay, Duggan has recorded a provision of 800,000 already. So all you need to do is to record the incremental amount of 120. So 800 is already been recorded. You have to record the incremental amount of 120 and its unwinding of discount. Unwinding discount. Okay, can you explain the unwinding of discount? Unwinding adjustment. Unwinding adjustment is actually made whenever we record the transaction at the present value. The difference between the present value and the future value is because of the time period, and as the time passes, there will be the increase in the liability. So this incremental amount is called an unwinding of discount, and unwinding of discount will always be reported in the income statement in the finance cost. The provision goes to current liability or non-current liability. Definitely, it should be settled in the next year, so it should be reported in the current liability. Point one is there must be a present obligation arising from the past event. Outflow of economic benefit should be probable, and the amount of the liability should be reliably measured. So if the company is able to reliably identify the amount of the liability, then the company can record the provision. Unwinding discount will be included in the current year's financial statements. Yes, because the unwinding of discount is related to the current year, so it should be included in the current year's financial statements. Okay. Okay, one of the favorite standard of examiner is IS 38. IS 38 is related to intangible asset. It says that you can only record purchased intangible assets or intangible assets through development process. You cannot record the internally generated or self-created intangible assets on the face of the balance sheet. Like I cannot record the internally generated brand, but I can record the purchase brand. I cannot record the internally generated goodwill, but I can record the purchase goodwill. Similarly, the most important area of this standard is research and development cost. For the research, IS 38 says that it should be charged as an expense. For the development, if the criteria are met, it should be capitalized. Once the amount is capitalized, then it should be amortized over its useful life. But if the criteria are not met, then it should be charged in the income statement. So there must be three items which should be reported in the income statement. One is the amortization of the capitalized development expenditure. The second one is the development cost when the criteria does not met, and finally the research cost. So there must be three items which should be reported in the income statement. Okay. Any double entry for the unwinding of discount. Double entry for the unwinding of discount is income statement debit and provision credit. Unwinding of discount will be included in the current years. Okay. How do you recognize the intangible asset as internally generated? How do you recognize? We cannot recognize the internally generated or self-created assets unless we have purchased that asset or the asset has passed through the research or development phase. Then, according to the rules for the development, it can be capitalized. Otherwise, you cannot capitalize the self-created intangible assets. So here is a question for you. The research and development expenditure is 40 million. The research and the development expenditure is made up of 25 million of the research and remainder being the development expenditure. The directors are confident of the success of this product, which is likely to be completed in March. So the project is still in the development phase. So the question is telling you that out of 40 million, the 25 million amount should be related to research phase, matlab means it should be reported in the income statement, and the difference of 15 million should be reported in the balance sheet. The remainder being the development expenditure. The directors are confident for the success of this project, which is likely to complete in March. So as the project is not being completed, therefore we cannot amortize this 15 million. Otherwise, we have to charge the amortization for this 15 million. Purchase research can be classified as intangible asset? Yes. If the company has purchased the research of some other company, then it could be capitalized. It should be capitalized. Okay. I have a confusion in day one slides. So I want to do a question again. I think we have done some mistake in day one in this question. So I want to solve this question again. So here is a question for you. I want all of you to please do attempt this question again and write your answer in the chat box. You only have 1 minute. Uh, it's my doubt that we might be we have might done this question wrongly in day one. Yes, the right answer for this question is D. So if you have any confusions in this question, you can ask it immediately. Damage. Is it B or D? It's D actually. Why isn't it an indicator? Actually, IS 36 is for the property, plant and equipment and intangible assets and investment property carried at cost. So this standard actually applies on these three assets, type of assets. So this portion, the estimated net realizable value of the inventory has been reduced due to fire damage, although this value is greater than its carrying amount, should not be considered as an indicator. And secondly, the question is saying that the NRV is still more than the carrying amount. So when we compare the cost and net realizable value, we take the lower amount. So if the cost is 100 and NRV is 120, although this value is greater than its carrying amount, so there is no indication there is a loss of loss in the inventory. Okay. Can you explain why is it option D? Okay, I have already explained it. Why not C? Okay. the carrying amount of the entity's net asset is higher than. In the last day one session, we have done the mistake in this portion. Actually, I was thinking it was a lower than. Whenever the carrying amount is lower than market capitalization, it means that the assets, it means that the share price of the company is below its par value. Then this will be considered as an impairment indicator. But when the carrying amount of the entity asset is higher than the market capitalization, then it means the prices is above the par value. So if the price of the company is above the par value, it means the company is going uh, with good profits and company is working uh, sufficiently enough and performing well. Then we cannot say that there is an impairment indicator. So when the carrying amount of the entity net asset is higher, this will be an indicator, and when the carrying amount is less than, then it means the company is performing well. When the carrying amount is lower than the recoverable amount, when the carrying amount is lower than the recoverable amount, there will be the carrying amount is lower than the impairment recoverable amount, then it means there is no impairment. So you cannot book the gain under IS 36. So there might be an impairment loss, or you can say there is no loss. Okay. So the carrying amount of the entity net asset is higher than its market capitalization. It means the price, share price of the company is lower than its par value. Then it means it's an impairment indicator. But if the par value, if the share price is above the par value, then it means there is no impairment indicator. So we are working towards the next slide. Yes. Sometimes examiner can ask you the question relating to IS2, that is inventories. So IS2 says that inventory should be measured at the lower of cost and net realizable value. So you are required to calculate the net realizable value or the cost, whichever is lower, and adjust this amount in the total stock. Like the inventory at 30th September 2003 was valued at 28.5 million. This includes 4.5 million of a slow moving goods. So for the slow moving goods, there might be a chances of the loss. So the cost of this slow moving stock is 4.5 million, and the terminal is trying to sell these another retailer to another retailer, but has not yet been successful in obtaining a reasonable offer. The best price it has been offered is 2 million. So the net realizable value of this is 2 million. So it should be reported at the lower value. So the inventory should be reported from 4.5 to 2 million. There will be a loss of 2.5. So when we adjust the loss of 2.5, the revised adjusted stock is now 26 million. Okay. So if you have any question, you can ask it immediately. Okay, please ask all type of your confusions. Please ask all type of your confusions in the IFRS, because it can give you 100% marks. in section A and B, and in the final account question. Secondly, it is a request for all of you to please give your feedback about this session, that whether you are gaining something from this session, and what is your opinion about this session, what is the feedback about this session, because ACCA is incurring a huge cost for these sessions. So please give your valuable feedback. Okay. IS 12 and 33. IS 12 is what I have already covered in day one. You can see the video lecture. And IS 33, I will try to cover in day 4, because as compared to IS 33, I think consolidation topic and the ratio is more important. That will be covered in day 3 and day 4. Loss on the cost of the inventories were classified. Actually, the losses on the inventory, when you adjust the stock, is automatically incorporated. There is no need to adjust or record the loss separately. Now here we have the format. Your income statement should be in this format according to the requirements of IS 1. So you should have to follow this format. So try to focus on the initial statements, on the currency unit, precision level. So this can uh, give you additional 1 mark if you follow the proper format. Then this is the format for the statement of change in equity. Statement of change in equity. All of you should have to memorize this format. So examiner can ask you questions relating to the statement of change in equities. And this is the format for the statement of the financial position. Oh, okay. There are some useful technical articles which the students usually ignored at this stage. So it is highly recommended to use the ACCA resources like technical articles and past papers and specimen exams, and especially the examiner's feedback of the previous attempts is very important for the students. So mostly students ignore uh, these ACCA resources. So now we are moving towards our assignment section. Now, Dugan question, Dugan question was come in uh, came in December 2018 attempt. So it is the question from the last session. And here you can see that we have already covered the note number 1, that is relating to the construction contract. We have covered note number 2 already. We have covered the text portion in the last session. We have discussed the treatment of convertible loan in day 1. So this is again the area that you can easily attempt. And began the construction of an item of the property plant. So this is one of the adjustment that we have to attempt. Dugan begins to construct an item of the property plant on 1st July 2007, which was completed on 31st March 2008. The cost of 32 million was capitalized. This includes 2.56 million being a full 12 months interest of 25.6 million into 10%. So after reading this 2 or 3 lines, you should understand that this adjustment is relating to IS 23, that is borrowing cost. And loan taken out of the specifically with the construction on the completion of the property has a useful life of 20 years. Duggan also recorded 0.4 million operating expense representing depreciation on the asset for the period from March 2008 to June 2008. So as you can see that the construction of the asset continues from July to March. So July, August, September, October, November, December, January, February, March. So the construction actually continues for 9 months. So according to IES 23, the borrowing cost can only be capitalized if the asset is qualifying asset, and borrowing cost can only be capitalized for the period in which the active construction is in progress. So the active construction is in progress for the period of just 9 months. So you only have to capitalize the 9 months interest. So 2.56 is the full 12 months interest. You have to proportionate the interest amount and adjust the cost of the asset and its depreciation accordingly. So this is again a very simple adjustment that you can easily attempt it. Then there is a question relating to fraud. Fraud is relating to actually IS 8. We have already covered in day 1. So this is again an adjustment you can easily attempt. Those who have missed day 1 session can join the group. I will share the video of day 1 and from which you can study whatever you have lose in day 1. On 1st on 1st November 2009, this is again one of the favorite areas of the examiner, which the examiner can give you in any question that is related to the right shares. Sometimes it might be a bonus shares or it might be the adjustment relating to the suspense account. So Duggan Company issued 1.5 million shares at the full market price of 2.2. The par value of each share is, I think, 1 million. I can see here on the face of the trial balance. Yes, the par value is 1 million. So in on 1st November, Duggan Companies issued 1.5 million shares at its full market price of 2.2 million. So the company has recorded this transaction by debiting the cash by 1.5 into 2.2 and crediting the suspense account. So all of you are required to debit the suspense account and crediting the share capital and share premium account. So this is the basic double entry adjustment that you have already studied, that is related to your past knowledge. So it is an assumed knowledge for F7 suspense account. So the accounting entry should be suspense account debit and share capital, share premium credit. Now, Duggan is your assignment for the next class. You are required to prepare the income statement, that is statement of profit and loss, means there is no need to adjust the OCI. The statement of change in equities, and there is no need to prepare the balance sheet. In fact, you have to calculate the basic EPS. So for the calculation of the basic, it's very simple. You only have to show the profit for the year in the numerator and you have to divide this with total number of shares. Then you can calculate the basic EPS. So it is very simple to calculate the basic EPS because in the numerator we have been, you have to show the profit, and in the denominator you have to report the total, you have to report the total uh, number of shares. Triage is already we have done. Those who have not yet attempted a triage are requested to attempt triage. Then send down is the assignment of day 1. We have already discussed and covered send down. Now, termulate is again your assignment. So all of you are required to do termulate and Chamberlain. So I have almost covered all the adjustments of Chamberlain and termulate. So by tomorrow you are required to solve 3 questions. The first one is Chamberlain, The second one is tourmaline, and the third one is uh, Dugan. So please solve these questions and give your valuable feedback about the session. And please send your solutions to my email. You can solve these questions on the ACCA platform, or you can solve these questions. Uh, you can solve these questions on the Excel. So it's very highly recommended to solve all these 3 to 5 questions till the examination date and do practice of these 5 questions. So if you have attempted all these 5 questions, I think it's more than enough till the examination date. So there is no need to further practice the questions till the exam date. You can only practice the MCQs and the questions related to section B. So it is highly recommended to solve this question and send it to me through the email, and I will check your answers and reply you with the constructive feedback. You have to focus on your weaknesses. You have to focus and you have to learn from your mistakes. So for tomorrow, we'll be discussing the consolidation topic. So all of you are required to please prepare yourself for the consolidation and attempt all these 3 questions. Thank you very much. Take care. Allah Hafiz.